Hey everyone, in this video, I'm going to bring you one growth stock that's down 55% off its high that I think is an excellent investment for 2024. In fact, this growth stock is rated as one of my top stocks to buy for 2024, which I will have a list coming out a little bit later on in the month. But for now, let's look at this one growth stock and all the reasons why I think it makes an excellent investment.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the growth stock that I am going to be talking about in this video is the Walt Disney Company. It is down 55% off its high in the last 3 years, and I think it makes an excellent investment heading into 2024. Let's start taking a look at why I think that's the case. So in its most recent quarter, Disney Plus added nearly 7 million core subscribers in the fourth quarter. Disney Plus has done an excellent job adding millions of subscribers, focusing on profitability and shedding unprofitable customers. Disney Plus, the management team has also focused on making less content and making more content that viewers love. So by now, the company has several years of data on Disney Plus, and they can make better decisions on what kind of content to create, and thereby making it more efficient in terms of spending on content. They won't be spending as much on content that's not attracting customers and not retaining customers. And for all those reasons, management expects that the combined streaming businesses will be profitable by the fourth quarter of fiscal year 2024, which is coming up in 2024, although the progress may not be linear. So the streaming side of the business is doing very well. Additionally, experiences, the segment that includes its theme parks, its hotels, its cruise ships, operating income is absolutely soaring, increasing by 30% versus the same quarter the prior year. And this has been the story throughout 2023 and for most of 22 as well. As economies reopened and Disney was allowed to reopen its businesses, it's been thriving, it's been soaring. Disney has increased prices meaningfully across the board, and consumers are paying up. They're unleashing pent-up demand for away from home experiences, and Disney is absolutely benefiting from that trend, a trend I fully expect to continue for 2024. Disney continues to manage its cost structure aggressively, and they announced efficiency target gains of $7.5 billion versus the previously estimated $5.5 billion. So new CEO Bob Iger, when he came in, he said, I'm going to slash costs by $5.5 billion. And while doing that, he said, you know what? I've identified more opportunities to cut costs, and he raised the cost saving target to $7.5 billion. That's going to provide significant profitability tailwind for Disney in 2024 and 2025 and beyond, for that matter. And for all those reasons, management expects to grow free cash flow in fiscal year 2024 significantly versus 2023. And it's going to approach levels last seen since before the pandemic. I'm going to show you in a little bit how Disney's business is still not completely recovered to where it was before the outbreak. So in 2024, management is saying it's going to almost be there. It's almost going to be where it was before the pandemic, and it's expected to only grow from there. Now, another thing that investors may have been confused about with Disney over the last few years is there's been a lot of changes at the company, a lot of restructuring and reorganizing, and those things have led to an income statement that's been difficult to read because it was showing you income in a certain category, and then it changed it, and then it changed it again. And this was due to the pandemic. Yes, it was due to the company changing CEOs and then changing back, right? Bob Iger was the previous CEO, tried to retire and hand the reins over to Bob Chapek, and shareholders did not like what Bob Chapek was doing, and then they asked Bob Iger to come back now. So that's been happening. Additionally, Disney has been transitioning from a legacy content consumption model to a streaming content consumption model. So that's leading to changes in the income statement. Additionally, Disney acquired the Fox, and that was a massive, nearly $80 billion acquisition. And so all of these factors have made the income statement really difficult to read, even for someone like myself who's been trained on this. I've, taken uh, thousands of hours of training and reading income statements, and it's been difficult for me as well. When this happens, when there's all this changes, what I like to focus on is cash, because cash is cash, right? You can't reorganize cash. And so that's why I've highlighted this item here: cash provided by continuing operations. And this metric has been doing well, right? 4.8 billion in the quarter ended September 30th, up from 2.5 billion, a 90% increase in the most recent quarter. And for the fiscal year that ended September 30th, 9.866 billion. That was up 64% from the 6 billion the prior year. So the company is doing well. But you wouldn't know that if you looked at the earnings per share, because if you look at diluted earnings per share, right, that's down 26% year over year. Down 26% to $1.29 from $1.75. And you might say, well, how can that be where cash is booming, but the business is experiencing decreasing earnings per share? And it's for the reasons I mentioned earlier. All those restructurings and changes, the company takes write downs and uses these to offset some of its income in 2023, and thereby pays a lower tax bill. But cash doesn't change hands. It doesn't move how cash comes into the company. It just changes how the company accounts for the revenue and profitability. So if you look closely, this is a really good thing for investors looking for an investment like Disney. I told you the company has not yet recovered to pre-pandemic levels. 8.99 billion in operating income in the trailing 12 months. That's still well below the nearly 13-14 billion it was generating before the outbreak. So it's got room to go. It's still recovering. It's still not back to where it was. Even though people are unleashing pent-up demand for away from home experiences, they're still not spending as much away from home as they were like around 2019. There's still room to go in this trend. That's why I expect it to continue. And the same thing for cash flow from operations, 9.866 billion in the trailing 12 months, still well below the peak levels before the outbreak in 2018, 2019, well above 12, 13, 14 billion dollars. So Disney still has room to go in that regard. And if you look at the consensus estimate from analysts, I have two things that I really like here. And if you've been a subscriber, you've heard me talk about the second derivative. That's the increase in the rate of growth, right? There is the rate of growth, and then there's the increase in the rate of growth. So if Disney, or any investment for that matter, is demonstrating an increase not only on the growth rate, but an increase on the rate of the growth rate, that's extremely positive, and Disney is demonstrating that on the top and bottom line. So for its fiscal year that's ending in September 2024, analysts expect Disney to grow revenue by 3.9% and earnings per share down here at 16.3%. For fiscal year 2025, they expect that growth rate to increase to 4.8% and earnings per share to increase by 20.2%. For the fiscal year 2026, analysts expect Disney's revenue to increase by 4.5%, with earnings per share increasing by 21.2%. So Disney's earnings per share is expected to grow not only robustly 16, 20, and 21%, but that rate of growth is increasing from 16 to 20 to 21. So it's demonstrating that second derivative growth, which I truly love to see in an investment, because it shows you that they're getting better and better and better at doing what they do, and expectations are for that to continue. There's opportunity to continue capitalizing on profit expansion. And finally, given all of these positive characteristics, Disney's stock is trading at an attractive valuation at a forward price to earnings of 17.1, nearly the lowest you've been able to buy this stock going back all the way to January of 2021. Now, there are risks with Disney. right? The company is transitioning from the legacy cable business model to the streaming, and that transition has been messy. It's been messy. I've highlighted all the changes on the accounting, the changes in the CEO, and all of that. It's been messy. And so it's understandable that investors were hesitant to approach Disney stock. But I think it's an excellent value. It's an excellent stock. And that's why not only am I recommending it here, but I've also placed it in my list of top stocks to buy for 2024. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.